Mentioned Powell tomorrow. Some are now adding another rate hike to their models. Is that the biggest risk event of the week? Powell tomorrow, Washington Economic Club, which, by the way, we'll have on this program?
Yeah, for certain, there's a little bit of hesitancy to extend the rally from last week today. I also think you have to factor in a little bit of an introduction of geopolitical tensions, whether it's the U.S. imposing that 200% tariff on Russian-made aluminum, and then certainly
the balloon shoot down,
the Chinese tension. So I think there's a little bit of a geopolitical hesitation right now for equities. As it relates to Chairman Powell, Scott, I don't know that you're going to hear anything different than what we've heard from the chairman. He's going to remain overly hawkish, and I think you're going to have this.
Well, he wasn't, but that's the thing, though. And you nailed this the day before the actual meeting. He wasn't overly hawkish.
No, but he wasn't hawkish. He wasn't hawkish enough. I think what's happened is that the communication, they're utilizing the communication as their most significant tool. They're limited in the scope of their actions now. What are they going to do? I mean, they're going to raise another 25 basis points in March, probably. Okay, that's really not going to shake the bullish price action that we've so far seen.
So you're not worried about him trying to walk anything back or have a more hawkish message or tone. Remember, it was the demeanor and the message that, so calm. He's calm and cool this time. And the message was dovish, not as hawkish as we thought.
Am I worried about it? No. Would it be effective if he did it? Without question. It's there that the Federal Reserve is responding. Remember, I've said you don't want to agitate the Federal Reserve with bad behavior within the markets. There, the Federal Reserve is acting much stronger than they did last week. They're showing that, you know what, we're actually a little bit concerned about financial conditions being the easiest that they've been in the last 12 months.
He had a chance to deal with that last week. He didn't do it
last week. He didn't do it.
So are we worried that he's going to do it and deal with it this time? Because the narrative, right, has really gone from hard landing, soft landing, no landing?
No landing.
Right? Because the jobs report was so strong. I mean, whether you believe it or not, we'll have to wait and see on that. But still, do you feel like he's going to try and fix, quote unquote, anything from last week?
I don't know if he's going to fix or feel like he has to fix, but he will focus on the jobs report. We've talked, Scott, a number of times how there's such a mixed economy, right? We know manufacturing's weak, we know housing is weak, and we got that down. But the jobs numbers, it's not just on Friday's number that was so strong, right? It was the jolts, it was initial claims. I mean, the 4-week moving average for initial claims is now down 10% year over year. I mean, that's a really big deal. So across the spectrum, jobs are strong, and that's the bright part of the economy at this point in time. But the thing that Powell said last week, we're seeing disinflation in goods. We see the pipeline coming down in housing.
Right, he said disinflation like 47 times or however many times it was.
Right, but he also focused on core services, ex-housing. And what is that? That's jobs, right? That's the strength of the labor market. And so I think he's going to reiterate that point, that is what has to come down, and it's still too high based on what their expectations are across the board.
The big question, Sarat, is how much more can the market legitimately run? Okay, it's come a long way in a reasonably short period of time. Goldman's David Kostin today says the potential for further upside is limited. He says it's forced him to raise his own 3-month price target to 4,000 from 3,600, but soft landing's already priced in. I mean, no landing, I guess, is not priced in. But let's address the issue first. How much more can the market legitimately run from here?
And I think if you look at it and you say, well, the market's really been running with the big caps, and the big caps, for the most part, had their earnings last week. And we know that there are no short-term catalysts for those guys to go up right now, right? The short-term catalyst could be, the 10-year's coming down and interest rates are coming down. Well, we know that is off, right, at least now initially after.
It's been running from all the other stuff, too, though. So not just the mega caps.
Well, you can still have you can still have people make money. Doesn't mean that the whole market has to go up as a whole. I mean, you can look at areas like staples or healthcare or industrials where there are stock-specific companies you could own, so you can still make money. Just buying the index will not really work for the next couple of years.
Okay, but you're answering that question as if you don't think that there's much room left for the rally. That's how I read it.
Yeah, as an index, I agree with you. Because you got Apple, Microsoft, all these.
Well,
guys.
I'm not saying there's nothing left. That sounds like what you're saying.
I agree. Okay, I am saying that, yes. we're going to cut down words.
Yeah, let's parse it all the way down.
Go parse it all the way down. What I am saying is, yes, the market is going to the S&P for the next 6 months is going to be in a range. And for people to outperform, you don't necessarily only have to stick with the mega caps. You have other stocks in there that have the opportunity that can perform, because it's not just based on interest rates. It's based on secular growth and companies that have cash.